Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on Rachel's favorite topic. Here we are.
Gonna say that.
It's tax season, and we're going to be talking about some things to be thinking about and looking at when you do your taxes. So today we thought it would be appropriate considering how many days is left before tax season?
Less than 30.
Yes. So
counting down.
The clock is ticking. So we thought we'd have a conversation on that with you today. And so it's obviously, as you look at tax planning and taxes, it does tie into financial planning, and they do go hand in hand. And we often find is this, because people are doing their taxes right now, that this is also a good time to really take a step back and also look at your financial planning as well, and also what kind of planning can you do for this year. So we also think it's, looking at the kind of big picture, and obviously as you're doing taxes, you're looking at W-2s and 1099s and K-1s
P&Ls
and all that
and
fun
sheets.
stuff.
That's right. And honestly, I've always said the tax return tells a story of somebody's life. And so are you actually reading your tax return? You don't need to prepare your own return, but it's really important to understand what it's telling you. And so really it can tell you things such as, income trends. Is your income up or down? Is it inconsistent? Are you creeping into the next tax bracket? Is there some tax planning you can do to avoid that next bracket? Things such as missed opportunities. So we can talk about that a little bit. But
So it seems like obviously when you're doing your taxes for last year, it's kind of a rear view mirror of looking like, what did I do in the past? And obviously you want to get that handled and taken care of. But I think it's also
tax planning is looking forward.
Exactly. So,
but one of the biggest things that we see when we do returns is underwithholding issues. Mm-hmm. Maybe that's just the first thing I always see, because people want to know when they come in to file, am I going to owe or am I getting a refund? Mm-hmm. But oftentimes
and I bet a lot of people want to get refunds and not owe.
And believe me, it's so much better to tell people you're getting $5,000 back than telling them they owe $50,000. Yes. So some of the signs that you're underwithheld clearly is if you do owe a large balance, or maybe you're getting a refund, but you have what's called an underpayment penalty, because the IRS wants to make sure that you're paying in enough as you go, and so do the states. So some of the causes for underwithholding issues are if you received a bonus, if you are married and you both have jobs where you're earning, let's just call it over $100,000. Maybe you're in a job where you have restricted stock units or RSUs. Any sort of stock compensation, oftentimes I will see, people will end up owing huge amounts, and they'll ask, why do I owe so much this year? And it really sometimes boils down to, yes, they being the company withholds if you do receive restricted stock units, but they never take out enough.
And that's, I think, deceiving, because I think sometimes people think, well, I already paid the taxes, but
Correct.
The reality is, like you said, it wasn't enough. What about sometimes I think, what if you get married, or then that's a big change?
So the tax tables are antiquated. So basically, women's home with an apron on, barefoot in the kitchen. Yeah. So if you are both, and today, both spouses are working, but unfortunately, the payroll tables haven't been updated to take that into consideration. And so if there are two jobs in the household, or maybe one person is self-employed and the other one isn't, or maybe you're both self-employed, but if you do receive W-2 income, those payroll tables are definitely, they're not going to withhold enough. So you need to be planning ahead, maybe on your W-4, which is the document that you use to tell your payroll company or your company how much to take out of your paycheck. You put married filing separately, even if you are married, or you don't put dependents if you have dependents.
Because they'll withhold more.
They'll
right?
withhold more, exactly. And then the other thing that you can do, there is a line on the W-4 where you can actually fill in the amount you want them to take out that's extra. So for instance, I have for every paycheck an extra $250 withheld, because at the end of the year, we always end up owing.
Yeah. And so another thing that I think we see that comes up frequently is if you are taking required minimum distributions, and obviously now that age is age 73, and that changes. It's going to be 75 at some point, but at this point that it's age 73. So do you want to talk a little bit about that when you have to take RMDs and kind of what the tax surprise can be there?
So like you just said, the age depends on what year you were born. But if you do take out, so once you hit a certain age, the applicable age, I think is what it's called, the IRS requires you to take money out of these tax deferred accounts because they don't want you to have it grow tax deferred forever. And so every year, you have to take out a certain percentage, and basically you take the account balance at the end of the year, you divide it by what they call a factor. It's basically how long they think you're going to live, and then that's the amount that you have to take out on an annual basis. And you want to make sure you're having enough withholding on that. So I would work with your CPA or your tax advisor to make sure that what's my effective tax rate, and then make sure you're withholding not only for Fed but also for state.
And so talk about withholding. So, for example, when we work with some of our clients, if they take a required minimum distribution, if we elect to withhold taxes, then we send the taxes for them, and then they get the net amount. But if they don't withhold the taxes, then that could be a surprise.
That is a surprise, yes. So if there's no tax withholding, you can work with advisors and make sure that you're paying in quarterly.
So more of an estimated tax on your own.
Correct. So you're going to be, and I think that the IRS, well, I don't think it's 100% you have to do it yet, but they want you to be paying online. So you can go to the IRS Direct Pay website and make payments online. And the first quarter estimates due April 15th, so that's coming up pretty soon. And then your second one's due in June, the third one is in September, and then that fourth one is in the following year, January, so that trips people up sometimes.
Got it. And then on the tax return, usually on there you can see what kind of retirement contributions were made, so that's definitely something to consider and
That's
look at.
something that your tax return will reveal when you file, because oftentimes there'll be a missed opportunity where they did not max out their 401k, or maybe their income is at a point where maybe you don't have a retirement plan through work, or maybe you're self-employed, but you still can do traditional, or sometimes you can do Roth IRAs. And so the difference between the two being a traditional is pre-tax, you take the tax deduction on your return, and with a Roth, the money goes in post-tax, and then later the money comes out tax-free. And there's a lot of confusion, I think, out in the news media and social media platforms about Roth IRAs, because not everyone can contribute to a Roth.
I think the misconception, everyone thinks they can contribute. And so it's like, oh, wait a minute. No, there's income limits.
And I've seen people who contributed, and then here they come up to do their taxes, and I'm like, wait a minute, you couldn't do that. Your income's too high. So depending if you're married or if you're single, you have to make sure you're watching what your income is, and you can wait until you file your taxes to make a contribution for the prior year. So sometimes it makes more sense to wait to make that contribution until April 15th or when you're doing your taxes in the spring, because you can still make that contribution for the prior year up until the due date.
Correct. So for IRAs and Roths.
IRAs and Roths and health savings accounts.
Oh, and health savings. Okay. And then more rules are if you then take an extension, or if you file later for businesses, then they can still fund.
Correct. So
solar 401ks.
That's right. So IRAs, individual retirement arrangements, and Roths, they can fund only till April 15th. There's no extension. But if you're self-employed, you can do either a simplified employer pension or a SEP IRA until October 15th. Or September 15th, depending on if you're incorporated or not. So there are tricky little rules there. But you do have more time to fund those accounts if you're self-employed.
So it's interesting. You just mentioned something that triggered for me is, so from a tax perspective, you call it individual retirement arrangements.
Oh, that's right.
And then as working in the financial services industry, and the accounts that we open are individual retirement accounts. And so it's interesting when you actually dig in.
To the
individual
tax code.
Retirement arrangement underneath that is an individual retirement account, but a little nuance, I think, when we're dealing with different jargon and words, and
that's
so
interesting.
it's just I thought that was kind of interesting.
That's a good point. And so maybe you also are married, but you aren't currently working outside the home. So maybe you're staying home to take care of the kids, or an elderly parent, and your spouse works. You can still make a spousal IRA contribution if your spouse works and your income's under a certain limit. So I just wanted to mention that, because a lot of people don't realize that they can make a contribution for their spouse.
Okay. So let's talk a little bit about kind of Roth conversion opportunities. Once again, that's another big topic. It's all over the media, news, and everywhere. It was interesting. I just had a client call yesterday, and they said, well, one, they wanted to see if they had a Roth IRA, if we could fund one. But I was like, they are high income earners, so no. But then we were talking about potential Roth conversions, and because of their income bracket, it doesn't make sense now. But potentially, we're going to have the conversation. There might be a couple gap years before Social Security where they could do some partial conversions. But once again, I think the detail isn't out there, and so it's a little misleading when you're reading articles and everyone says you should do it. It's wonderful. which it is a great strategy, but it's not
for everyone.
It's not for everyone. And so that's the hard part is when you see it, you think I should be doing it, but the reality is you really have to have these conversations.
Well, and dig into the details as well, because like you said, even though you may have a gap year, might not make sense for you.
You have to
for your overall financial picture.
Correct. And so kind of moving on to AMT surprises. So obviously that's the alternative minimum tax. And we were just kind of collaborating and saying, we don't hear much about this anymore, but maybe you can share a little bit about that.
So the AMT, or alternative minimum tax, was a big deal before the Tax Cuts and Jobs Act, which passed in 2017. And so basically there are two tax systems that you're subject to. There's the regular tax system, which everybody knows about, but then there's the alternative tax system. And as advisors, we have to run your taxes both ways. And for the alternative minimum tax, there are certain deductions that you're not allowed to take, such as the state taxes. Mm-hmm. So when this Tax Cuts and Jobs Act came out and actually put a cap or a limit on how much state tax you could deduct, that's when we saw a lot of the AMT, or alternative minimum tax, going away. Mm-hmm. And not only that, but the alternative minimum tax only has two tax brackets, the 26% bracket and the 28% bracket. Mm-hmm. And for years and years, when they first came out with the AMT, it was meant to be for really wealthy people, so that they weren't taking advantage of all the deductions that were out there, and that they were not paying their fair share of tax. But I don't think that this was ever indexed for inflation. Mm-hmm. And so what happened was this bracket creep, and all of a sudden, a lot of people who were in the middle class are now subject to AMT. And so every year, Congress would pass what they called the AMT patch, mm-hmm. which basically was like a Band-Aid for this problem. And so they would raise the limits temporarily, and then all of a sudden that next year, everybody would creep back into it. So some of the other triggers for alternative minimum tax are, for instance, if you have incentive stock options. And what we saw, and this was when I started doing taxes, when the dot-com bubble burst in mm-hmm. Year 2000. So a lot of companies were issuing incentive stock options in 1999. Mm-hmm. And then, so basically what these were is, they were going to get compensation, but they were getting stock options, but they actually didn't have the cash. And then these companies went out of business. But under the instead of the ISO rules, incentive stock option, they had to declare the income in the year that they received the options. And so they had to pay these huge amount of taxes and under AMT. And so for the regular tax system, it didn't trigger any tax, but under AMT it did. And so people ended up paying tax on money they never got. So as a new advisor, I thought, wow, how unfair is that? And there are credits that you get later when you sell the options, but it just created a tremendous mess for a lot of taxpayers. Yeah.
So let's move on and talk a little bit about investment income on 1099s. And so for those investors that have mutual funds and taxable accounts, potentially there could be some capital gain distributions, or also if you have other investments, you might have dividend income or interest income. And so there's sometimes there's surprises that people don't realize, but also you have to realize you are making money, but also there is some tax planning involved too. And so there are things you could do. If it's a stock position, you can maybe do some tax loss harvesting, or you can also kind of look at how are the investments allocated between different accounts. And so there's definitely some planning that can go around that, even though it depends on the gain. I mean, there's a lot of moving parts that are involved, but definitely something to look at from a financial planning perspective.
Absolutely. And it's funny that you mentioned that because I've had a lot of clients that have told me, I reinvested that though. Mm-hmm. And they don't realize that if you have mutual fund distributions or capital gains or dividend income, interest income, and it was reinvested, you still have to pay tax on it. So there are things that the IRS calls the safe harbors. So you want to make sure you're paying in enough annually to satisfy those. So basically you're looking at your tax return and looking at, okay, how much did I pay last year? If my income's over $150,000, then I need to pay in 110% of the prior year tax to avoid penalties. So you have to pay it in through either withholding or through estimated payments.
And so I guess that kind of turns us into looking at now we're in tax season. You just completed your tax return. And like we talked about, obviously that was last year. And there are definitely some planning techniques and things to look at for the current year. So obviously you want to continue, to work and look at what can I do differently, or is there other things that we should be taking advantage of?
How tax efficient is your portfolio? Because there are different investments. I mean, long-term capital gains are taxed at lower rates than short-term and ordinary income. So you want to be looking at, how is my portfolio? Is it positioned? What's my asset allocation? How are those different how is that different investment income being taxed? Yeah. So,
well, and recently we met with a client that she had a new advisor, and what they didn't realize is this new advisor made tons of changes, and so they got, as they were reviewing their taxes,
it was a huge tax hit.
Yeah, and they weren't really expecting that. So, we're not saying go and change everything, but the reality is you really have to pay attention.
Yeah, you want to make sure that, because what we were saying, even though that income is reinvested, you still may be paying tax on it.
And so as we kind of wrap up here, a couple items to kind of look at, some action steps are obviously, look at your income for the year, and are there any other changes or updates you need to make?
Pull out your tax return.
Yeah, and then also look at how much.
I know you don't want to.
I know. It's like, oh man.
But look at it. I mean, how much was your total income? How much was the total tax that you paid? Did you make retirement contributions, or what was your investment income? Ask yourself, what surprised me?
Yeah.
And, what can I do right now to avoid tax surprises next year?
Well, and I think with some of the changes from last year to this year, hopefully that'll give us a little more insight too. Because I think last year we kind of got, we had the one big beautiful bill act that came out, and I mean, obviously it was a game changer for some people.
It's been really interesting this tax season, seeing how it is actually playing out, and who actually is benefiting and who is not benefiting. And so,
well, because even with the senior deduction,
not a lot of people are getting it. At least the returns I'm doing.
Yeah, and so it's just, once again, that's something a new dynamic that wasn't there in the past.
Well, and it's fun seeing that state and local tax deduction go back up. And for clients that used to not itemize, they're itemizing again. So I'm like, go get your donations and pull out your medical expenses, because guess what? You're itemizing this year.
So hopefully we gave you some good ideas. And once again, we're not saying do your taxes and forget it. We're saying do your taxes, review, plan. Obviously, there's a lot of moving parts, and we're happy to consult with you for a call or an initial meeting. You can reach us at 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.